already. This I'll just go very, very briefly. This is a guy who's a lobbyist he used to be a head of R&D at Pfizer at one point, John Lamattina, who took exception to Lynn Paramore's article, the one I just showed you. And he wrote on LinkedIn, his LinkedIn site, here are the irrefutable facts. First, biopharma invests 20-25% of sales directly into R&D. Second, the Inflation Reduction Act will lower Medicare spending by $300 billion by 2030. As a result of this decrease in revenues, there will be $75 billion less invested into R&D in this time frame, and thus less innovation. Why is this so hard for you to understand? So this is the typical argument made. It's possible that he's right, but he's actually wrong because of exactly what Lynn Paramore wrote in his article. So I don't usually do this, but I went on LinkedIn. Owner told him, said, you got to go on LinkedIn and respond to Lamattina. And I said, pharma companies can cut back on buybacks to maintain their R&D spending. Take a look at Lazonick and Tulum, stick with shareholder value, article of ours. Why should we pay higher drug prices so big pharma can use buybacks to manipulate their stock price? I put in parentheses, is this so hard to understand? Okay, so Lamattina got back and he said, William Lazonick, if shareholders don't get a financial return, they don't invest. Look at the $4 billion in spending cuts Pfizer is making as a result of the drop in its stock price. And it's not really a drop in its stock price, it's because its revenues from the COVID vaccine disappeared. I am astounded that you don't appreciate the huge investment pharma makes in R&D and important medicines to deliver. So I wrote him back. John Lamattina, public shareholders are savers, not investors. When they buy shares in the stock market, not 1 cent goes to the company for investment, productive capabilities. Retained earnings are the financial foundation of the growth of the firm. Public shareholders, as savers, should get a modest dividend and expect that corporate managers will invest in innovative products and processes. If these investments in productive capabilities are successful, the company's stock price should rise, and shareholders can, if they so choose, sell shares for a capital gain. Buybacks as open market repurchases undermine innovation and reward those share sellers who have the non-public information to time the market manipulation. To be sure, pharma companies spend substantial amounts of revenues on R&D, but R&D spending is not R&D productivity. In-depth firm-level research by the Academic Industry Research Network provides evidence that when senior corporate management focuses on using large-scale buybacks to manipulate stock prices, the productivity of corporate R&D suffers. Well, of course, well, actually it wasn't, there was someone else who then came up with a comment that pharmaceutical companies put profit before people, and then some guy named BuzzQ, who I guess knows John, said, John, they don't want to understand, and John Lamattina said, BuzzQ drives me nuts. Well, I think we won that one. Okay, but that's what's going on, and that's the facts you have to deal with, and we know there are two sets of facts out there in the world, and you have to figure out which one you agree with. It is possible to go from innovation toward, from financialization toward innovation, and we have a book, Owner Tulum, Antonio Andreoni and I, which is available actually, I think it's free access online, about how AstraZeneca and GlaxoSmithKline, which are shareholder primacy companies, but stopped doing buybacks and started investing in the pipeline because they had to wanted to remain independent, not get taken over by American company. Pfizer tried to take over AstraZeneca. Now there's this other part of the pharmaceutical system that we have to understand, which Owner and I coined this term PLIPO, and a fellow named Erdem Sakinc, who worked with us, still works with us, but this is a little over a decade ago, 15 years ago, about a productless initial public offering. The way it basically works, and I live in Cambridge, Massachusetts, so these companies are all around me, is they go public without a product. Moderna is one example, which went public in 2018, which then made a lot of money on the COVID-19 vaccine. But there's no product. They get, if they're well hyped and the market's liquid, they bring in a lot of money. They actually couldn't use that to invest in R&D. A lot of people get very rich, but it doesn't really matter if there's a product. The people who are giving the money to these companies in the initial public offering, often secondary issues, don't really hang around to see whether they have a successful product. It's only if the market is liquid and there's a speculative play and they can sell the shares back on the market, make a gain that they're in it for. And in fact, these data show the extent to which IPOs in life sciences actually have become more and more relatively important as IPOs, as tech and other IPOs have dropped off in terms of the numbers. This one shows the extent to which IPOs in life sciences are FLIPOs. And basically, that blue line is a percentage that have zero profitability or close to zero profitability when they go public. So you can see the red line is the IPOs of life sciences, IPOs going up in the last decade or so, and the profitability being almost zero. And the same shows up if you say how much sales they have. They usually have no sales. So they're basically going on as speculative plays. Now here's one that we tracked over a long period of time. It was founded in 1988. Coming out of the San Francisco area, but really originally incorporated in the Netherlands, was bought by GlaxoSmithKline, but then actually went back on the, was spun off in 2001, and then did an IPO in 2006. And that red line is the stock price. And you can see the stock price right after the IPO. And then if you follow it along over to where the stock price surges again around 2012, that's when they have a successful drug. The stock price is way lower when they have a successful drug than years before when they weren't predicting there could be any less than 4 years before a successful drug. So this is what it's all about. Actually, in this case, once it was approved by the FDA, people started dying, and the company then dissolved by 2014 after having been around for all these years. And we can actually go through the data and try to figure out who made money, who lost money on this, and what comes out of it. We have a project going on now, which if I start talking about this, I'll go on for hours, and I'll do it in about 2 minutes, trying to contrasting the business models of Moderna and BioNTech, the two companies behind or involved with the COVID-19 drug. And basically, we argue that the business model of Moderna right from the start was get a hold of science just to make money, and that's what it does. It did very little to actually itself develop the drug. The manufacturing does with a Swiss company, Lonza. Most of the development was done by the NIH. BioNTech is a much more innovative model. They need money to do science. Both of them made a lot of money from the COVID vaccines. They're not making that money now. Moderna is losing lots of money. BioNTech is in a much better position. And what we're doing is looking at them going forward, because we think there's going to be, and there will be, a huge revolution based on the mRNA platform. We're also probably going to be looking at a company in South Africa called Afrigen, which is trying to bring mRNA to the global south and is the host for the World Health Organization's mRNA technology transfer platform. So we might be able to, we've done the case study of Moderna. We haven't released it yet. We're doing BioNTech, and we hope to basically look at these different business models and how they can evolve in different ways in different places, subject to different sets of institutions. We've also been looking at other sectors, medical equipment, the same basic story. I don't really have time to go through it, except this case study. It's also not available. It's by someone who works with me, who just finished his PhD, Matt Hopkins. And it's about a company called Philips Respironics. And if you remember back to the spring of 2020, there was all this problem about ventilators. And Philips Respironics was a Dutch company, was supposed to supply ventilators to the Strategic National Stockpile. Actually, they were due in September 2019. They were not there. They were selling them on the market for 5 times the agreed price with BARDA, with the U.S. government. We got interested in this company, Respironics, and we looked at it, and we actually located the founder, Gerald McGinnis, who just died about a month or 2 ago. We really discovered the epitome of an innovative company. Just retained its money, reinvested, went from one person building up the company to 5,000 people, $1.2 billion in revenues, voted by Forbes as the best medical equipment company in the world, taken over by Philips, which is, you can have highly financialized companies outside the U.S., and Philips is one of them. And it's actually right now that Respironics is in tatters because they had foam in the respirators that were killing people, and they ignored it, and now they've been prohibited from producing these things by the U.S. government, probably other governments, and have a problem. And a lot of that we attributed to financialization. Medical supply companies are highly financialized. The medical insurance companies are highly financialized. Now, we also look at hedge fund activists. These are really powerful people. The relatively small number who are well known: Harald Icahn, Nelson Peltz, Paul Singer, William Ackman. And they go in and they claim that they're fixing companies, they're really looting companies. And they love stock buybacks because they can figure out when to sell the shares and at a higher price. That's what the whole game is about. And here we have a series of things. This is from my book, Predatory Value Extraction, and Jang-Sub Shin, my co-author, has a book coming out which elaborates this. And this is really an untold story, other than the work that he did for our book and what he's producing now, but how these hedge fund activists got so powerful with less than 1% of the shares of a company. They can change the board. They can figure out what to do through the proxy, tell them what to do through the proxy voting system. And the pay that they're bringing in makes the top executives that I showed you there look like paupers. Okay, let me just say a few things about private equity, and then I'll stop. We started looking at private equity because it's important in healthcare. Here is some data on the deals. It's not the only thing that private equity is into, but private equity has gotten bigger over time, and healthcare is more and more important in private equity. Here's the value, the same thing. Healthcare has become more important as part of this, but it's not the only game in town, but it's an important part. There has been, statements that said that this is problematic, that it's reducing quality, that it may even be increasing costs. And in terms of what I talked about in goods and services, a lot of the problem of private equity is it's going into services, not goods, and it's trying to squeeze out profits where no profits really should be made, and quality is going to decline inevitably. We went through actually PitchBook, which puts out data on this, all the different types of services that they can target. We kind of created a little notion of the healthcare delivery system to try to kind of say, well, where our private equity might be targeting this is part of a kind of let's say a budding research project that we have. And then we looked, of course, at people who have done the work on this. No one more than Eileen Applebaum and Rose Bott in their book in 2014 on private equity at work, Wall Street, when Wall Street manages Main Street, which tied private equity business model to shareholder value ideology in that book. I see it as kind of the other side of the private equity. So stock buybacks, the analogy or the analog of that in private equity is a dividend recapitalization. There's been, that is basically the company loads up the company that it owns with dividends, pays with debt, pays itself a dividend, and that's how you finance their gains, or one way they finance their gains. This has been called out. There were two books about almost exactly a year ago, came out within 10 days of each other. This one, that's why one here is journalists Christian Morganson and Joshua Rosner. These are the plunderers, how private equity runs and wrecks America. And they name names, and they go after people that I was surprised at the extent to which actually they went after people. It's not about healthcare, but healthcare is mentioned there a lot of times. And in a book by Brendan Ballou, who works at the Department of Justice, who's written on his own outside his day job, almost the same title, Plunder Private Equity's Plan to Pillage America. And he actually goes through a lot of the ways in which private equity has changed the rules, have changed even the way they can disguise their involvement with companies in kind of being engaged in predatory value extraction. I've had a lot of discussion actually both with Christian Morganson and particularly with Brendan Ballou about both sides of these things, the private equity, the public equity, the buybacks, the dividend recapitalizations. Private equity, these are just some headlines that we compiled a little while ago on private equity piling into health and into all different kinds of services, clinics, colonoscopies, et cetera. There's there's some good work out there. I probably didn't mention everybody here, but these are some of the things that we've been able to see. And there's a book that is not about private equity that I recommend everybody read by Brian Alexander, Hospital, Death and Dollars in a Small American Town, which is the problems of a local hospital has even with people who actually want to run it for the public good and without private equity coming in. And the point of this is that there's a vulnerability out there unless we support those healthcare services that are going to be the predators are looking at. And the hospitals often will sell out to the predators because that's the only route out they can take from being in debt, not being able to deliver services. And that's obviously a huge regulatory problem. There's the case of Steward Healthcare, and this is something that actually Eileen Lapham-Monroe's bought with a colleague, their first name LaFrance, wrote on Steward Healthcare System, which had been a public charity, got into problems, taken over by a private equity firm, Cerebus, which sold it off a decade later after doing a sale-leaseback deal with a company called Medical Properties Trust. Basically took the properties of the hospitals, gave it to the trust company, the real estate income investment trust. They now pay rent to them. They've been having trouble paying the rent recently. Cerebus got out with a huge gain, and Steward has gotten into deeper and deeper financial trouble and announced last December that it was going to close one of its 9 hospitals in Massachusetts, and it did that on April 1st. This is basically the last slide I have here, because this is the whole Massachusetts congressional delegation piling in and saying, hey, what's going on here? And actually the point I want to make with this slide is that we should be doing the research so when this happens, they know what's going on there. And some of it's been done, and I think even the fact this was led by Elizabeth Warren and Markey, of course, it's all Democrats, but it was everybody in the Massachusetts congressional delegation. First writing to the Steward CEO, a guy named Ralph Delatorre, who had been at the previous company, had sold out to Cerebus and bought him out and still there. He's got lots and lots of money, saying that this is creating a crisis. He didn't really respond, so they wrote to Cerebus and they said, didn't you create the problem when you bailed out in 2020? And they gave them 14 questions to answer, which Cerebus gave minimal or evasive responses. And then Senator Warren and Senator Markey wrote in a kind of on a press release, Cerebus' response confirms the key points of this whole dirty saga. Cerebus looted Steward, failed to invest in Massachusetts facilities, and appears that the company walked away with a profit of at least $800 million, leaving Steward with massive ongoing lease payments to Medical Properties Trust that are a major source of the hospital's financial distress. I quote this not just simply because that's what they said and it's out there, is because actually they wouldn't have been able to say this. And I could give you examples of stuff on stock buybacks as well. And there's been legislation to try to get rid of stock buybacks that I didn't get into. The legislatures would not be able to say even that without the research that's been done on this, and much more research needs to be done. Thanks.
Thanks for that really extensive lecture covering everything from buybacks, private equity, Elizabeth Warren, Steward. I'm sure people have a lot of questions, so we'll open it up. We don't have much time.
Going back to one of your earlier slides when you mentioned shareholders and just value extractions in general, when you think of the number of pensions, 401ks, everything else are sort of wrapped up in this, what are the ways, if any, to unwrap it? Because it sounds like a great idea until you tell someone those stocks that they're so happy about, they're a 401k millionaire, may not be some, without sort of major crash.
Yeah, that's a good question. And I might say that Cerebus, and one of the part of their response is because pension funds invest with them, which I didn't read out, was about how millions of farmers, firemen, or teachers, etc., are now firefighters are benefiting from all this. I think it says it somewhere there. Or maybe I didn't put it in there. But in any case, in a book, Predatory Value Extraction, the core of the book is about the process. And we have kind of 3 parties involved, what we call the value extracting insiders, enablers, and the outsiders. And the insiders are CEOs with their pay. And they bought into this whole thing with that stock-based pay. And we've traced more than anybody the evolution of how that stock-based pay evolved and really was part of the shareholder value movement in its current form. So they bought into this. The other end of it, the corporate raiders of the 60s, like Carl Icahn, became now the hedge fund activists, and they changed the rules of the game to make themselves much more powerful. And so if you want to maintain control of the company and you have a lot of profits, you better do buybacks or you're going to be out. And it's really through the proxy voting system, through the proxy advisory system, these companies, ISS, Glass Lewis, basically they can go in and they can change it. And many of the executives just go along because that's the way they do things. And so we get billions or tens of billions of dollars that's flowing into the financial sector from buybacks just as a bribe to leave our company alone. Okay, now what you asked about, it was what we call the enablers. So there's the asset managers who can decide if they're going to invest with the hedge funds or with private equity. And okay, the reason they feel the pressure to do this is because they are the ones. I don't usually use short-termism, but that's where short-termism comes in, because their managers are judged by, did you get the yield that everybody else got? So that's what they're trying to get, that edge. Now, sometimes they win, sometimes they lose, but that's what they're trying to do. Now, we've argued that and sometimes we've done it directly to, we've done it more to state controllers and people like that, who say, if you're protecting people's pensions, you should want a reasonable stream of income from dividends and having the companies reinvest. And when you decide to sell those shares, if the company has been run well, the shares are going to be a higher price. And that's what you can be. You can do that, and you don't, so you don't have to show these quarterly yields, and you have to suppress that. Now, if they can't suppress it, we need the government to do it. But they are the enablers. And now what further enables them is part of the proxy voting system was basically, it goes back to the Department of Labor selling pensions in 1988, that it's called the Avon letter, that they had to vote the shares in their portfolios. Now, they don't know. They got thousands of shares, different companies, et cetera. So they turn to proxy advisory services. The SEC in 2003 made that mandatory for all and kind of solidified that, including for mutual funds, and said, if you're not going to vote the shares, you have to give us an explanation. So they want to tick the boxes. The most important thing is who's on the boards. And so they go to the proxy advisory services. There's two, ISS, which has about 2/3 of the market, that are the biggest, and Glass Lewis, which actually comes out of the Canadian state provincial pension funds, Alberta and Ontario. And you go lobby them. They're small organizations, and say, put your votes behind this slate or that slate. Actually, was played out. You could recently read about that with Disney. ISS did not support the raider. Nelson Peltz was one of the worst of them, but supported current management. Anyway, but that's what's, so there is this power struggle going on there but it's all about predatory value extraction. Now, if we could say to the pensions that, you shouldn't be going after this money, that should be putting, that's actually undermining the pension system in general, then we'd be making some progress. Now, the other part of it is the pensions that have been the most active in trying to get these higher yields are the public pensions, particularly the big California pensions, CalSTRS and CalPERS. So they're not putting the workers out of work in the company, because it's not the public pensions. I mean, the companies that are issuing stock are the ones that need to employ the workers. Their own pension funds are less active with this, and of course, but they've been declining because they don't have as many defined benefit pensions anymore, and it's really, the 401ks are all outsourced. So it's a very important part of it. But if you could get the pensions on board for progressive value creation rather than predatory value extraction, we'd be in a better place.
And so if more money gets paid out for dividends and stock buybacks than net income, that money, the extra money that it takes to do that, has to be gotten by borrowing, unless there's something else that I'm not thinking of.
You can, lay off workers. So you often see companies laying off workers at the same time they're doing buybacks.
Well, but that doesn't get them cash.
Well, no, yeah, because the revenues that they were paying, now, the proviso is that they can still get the revenues without those workers. That's not going to be for very long, but
Right,
they
but
can do
still,
that.
if they're paying out
Yeah.
more in dividends
Yeah,
and stock buybacks, so they're
but they
getting,
do
they're
borrow a
getting-
lot. So we have an article, I wrote with William Lazonick and at Hopkins. It was in Harvard Business Review in January 2020. Was about all the borrowing that companies are doing, were doing then. This was before we saw the pandemic coming, but to do buybacks. Yeah, so that is one way they can sell off assets. But there are, and they sometimes do cut back in R&D. And I should say that actually R&D, you can't focus on, if you're focusing on pharma, of course, you're focusing on R&D, but of the S&P 500 companies, only 40% record any R&D spending at all. But most companies don't do R&D spending. So it's not, there's all kinds of other kind of learning that goes on in companies if you're not keeping people employed or you're selling off assets that can undermine your innovative capability. And I've lots of cases of companies that sold off assets that are then become critical for the next round of innovation, maybe before they saw that. I mean, so that's what they're doing. And a recent case that we wrote about was after the UAW strike was settled, and GM did a $10 billion buyback, which was called an accelerated share repurchase, which would mean that they did a whole lot at one time. But it was $10 billion. It was part of $25 billion they had done since 2015. And that's all to keep hedge fund activists away from General Motors. And in this case, they clearly, we called it, I think the title was, will GM's $10 billion buyback ice the its EV transition? It, at the same time, cut back on its projects for the for electric vehicles. So we can see this in various cases where these pressures are being played out and how they're being paid for.
But if their risk is going up because of increased borrowing, and the risk is going up because of decreased investment in future innovative capacity, then you have to also be assuming that the market is stupid if that is being rewarded by increased prices. But the whole theory of the hive mind of how the market values stock prices is that stock prices reflect the best estimates.
Yeah, well, it's wrong. I mean, so
unless you're saying that somebody can actually manipulate that.
So, well, stock buybacks manipulate the market. So there's innovation, speculation, manipulation that drives stock prices. I can go into that. But the fact is, the stock market is stupid unless you're the one who's making all the money out of it. And these are the ways in which they figured out how to make money out of it while everybody else loses. The other thing I should mention is that when you really want to really up the game and have more money for stock buybacks, you get tax cuts. And so the whole debate around the 2017 tax cuts, which was called the Tax Cuts and Job Act or something like that, was whether they were going to do buybacks. And the people for the tax cuts said, yeah, companies will do buybacks, and that's great. It's going to get up stock prices. And the Democrats, led by Chuck Schumer, who's a big opponent of stock buybacks, were saying, no, they called it hashtag GOP tax scam. This is going to just lead them to use their higher profits to increase from lower taxes to increase their buybacks, which is exactly what they did in 2018. The only problem with that under Biden, who was as vice president a big opponent of buybacks. I met him twice after he read my Harvard Business Review article in 2015, and he wrote about this in the Wall Street Journal in 2016 and on the campaign trail in 2020. Buybacks have been even higher under the Biden administration than they were before. That is not saying because of the Biden administration, but they've done virtually nothing to try to stem it.
All right, I think we're actually over time. Thank you, Professor Lazonick, and thank you all for coming. We have one additional lecture series in 2 weeks, correct? 2 weeks. All right, thank you all.
you.